Good day guys, it's Manny here, and in this video we'll talk about everything you need to know about the current situation of recession. Currently, the fear of recession is mounting in the United States. Where do you peg the probability of recession right now? Let's say by year end, I would say 50-50. It's pretty close, isn't it? In June 2022, the World Bank slashed its global growth forecast to 2.9%, warning that not only US but several countries could fall into recession. I think there's a lot of fear just around how it's going to play out, how long it's going to be, and how deep it's going to be. And it hurts a lot of people. I think the pain tends to be kind of concentrated in the victims of recession. Recession also often affects the valuation of other asset classes like the value of your house or the value of your car. So what causes the recession? However, most recessions are caused by a complex combination of factors including high interest rates, low consumer confidence, and stagnant wages or reduced real income in the labor market. In short, 2 negative quarters in GDP is termed as recession. Economic research defines a recession as a significant decline in economic activity that's spread across the economy and lasts more than a few months. But some believe that this isn't all about bad news. Some investors, they took at recession as opportunities. This is an opportunity to buy this asset that's now on a sale. Now it's at a fair value. I think it's really important to just understand the mechanics, because I think when you do, knowledge is power, information is power, and then you can start to be able to seize the moment. Research Service cites 3 main causes of recession. The first is an overheated economy. When I talk about economy being overheated, I mean that demand in the economy is growing faster than the ability of a supply side of economy to satisfy it. And that can be because we just can't produce enough stuff, or it can be because we don't have enough workers. A hot spike in inflation alongside a dip in the unemployment rate could signal that the economy may be overheating. Every recession but one since World War II has seen an inflation hike right before the start of the downturn. And nearly every recession since World War II saw the unemployment rate fall to 5% or lower. When unemployment gets really low, it means that there's not really very many available workers for the firms to hire. And if firms can't find workers to hire, then they have to start bidding up wages. As they start paying people more, people have more income with which to buy goods and services. More income buying goods and services tends to push up the prices of goods and services higher. So you get a positive feedback between wages moving higher, pushes prices higher, pushes wages higher, pushes prices even more higher. And if the Federal Reserve don't intervene by inducing a recession and raising interest rates, that spiral would get stronger and stronger and stronger. And eventually you would have inflation running away and really getting out of control. Asset bubbles can be another direct cause. The first recession of the century in 2000 or 2001 was primarily caused by the dot-com asset bubble, while the recession occurred just after that. That has a big negative effect on the economy. When that happens, people find out that they are not as wealthy as they thought that they were, and you cut back on your spending. And as you cut back on your spending, that decreases the demand in the economy and it slows the economy down, and then enough of it can cause a recession. Number 3, black swan events. In other times, recessions are caused by unpredictable events that lead to severe disruptions. Call these events black swan events. These are the things that unfortunately we cannot manage or control. We cannot control COVID-19 or Ukraine war that's happening, But when they do happen, usually they are fast and furious and have an immediate impact and a very quick recession. And that happened in 2020 throughout COVID. The US has experienced at least 30 recessions throughout history, dating back as early as 1857. I do think recessions are part of our business cycle. If you want to know more about the business cycle and the four stages of business cycle, I'll leave the link above the video. Anyway, continuing with our video, it's a human psychology to get too excited about some things. And when you get too excited about those things, you ultimately have asset bubbles. And those ultimately lead to recessions. It's also part of the human nature that people will continue expanding their firms and businesses as long as the economy is doing good. And as long as that keeps happening, you will eventually overheat, which eventually leads to recession. Nonetheless, certain measures can be taken to make recessions less likely. As the nation's authority on monetary policies, the Federal Reserve plays a critical part in managing those recessions. With the right monetary policy, the Fed can prevent the recession. However, it's very difficult to do so. There are two things that the Fed can do to avoid a recession. Steer the economy so we don't get so much inflation that they have to slam on the brakes. The second is to pay close attention to the financial system so we don't have to repeat like the 2008 and 2009 recession, which was caused by too much lending, too much mortgages, and too much careless scrutinization of the part of the Wall Street. The Fed has often attempted to avoid recession by engineering what's known as the soft landing. This is where precise interest rate hikes are used to curb inflation without pushing the economy into recession. But a successful soft landing is extremely rare, arguably achieved only once in 1994. So what they're trying to do is raise rates enough so demand slows. So it's really a tough needle that they're trying to thread to get our economy in equilibrium. Now the question is there an amount of pressure that they can apply onto the brakes that's enough to control inflation, but not enough to crash the economy? And the truth is that it's difficult to get into that really narrow zone. It's a difference between trying to land an airplane in a really wide spacious zone versus trying to land a plane in a very narrow space of land with rocks and water on either side. There are several early signs of recession that investors look out for. One tool that commonly cited is the yield curve inversion. When the yield curve tends to invert, it means that people expect that the bond market expects interest rates to be higher in the short term than it does in the long term. That's because the Federal Reserve hikes rates to control inflation, and then after the inflation is controlled, it cuts interest rates back down. So if you see the market expects higher interest rate in the short term and low interest rates in the long term, that's indicative that recession is coming, followed by the interest rate cutting cycle. A lot of people look at some of the manufacturing indices like the ICM manufacturing index. When it tends to be above 50, that means the economy is expanding. But when the ICM starts decelerating and approaches 50, a lot of people say, okay, the manufacturing side of the economy is going to contract. That could be a recession indicator. If you want to know a bit more about ICM index, I'll leave the link in the description. The third recession indicator that is consumer confidence, and suggests that, well, if consumer sentiments and consumer confidence goes negative, that means consumers are going to pull in, take the credit cards away, and not spend. And that could cause a contraction in the economy. A diverse portfolio can often provide the best defense. If you want to know a bit more about which stocks to buy, I'll leave the link just above the video or in the description about which stocks to buy in the recession. So diversifying your holdings of assets to make sure that you are including not only growth stocks, but more value stocks and more defensive stocks, like healthcare, like the utilities market. These are the companies that could manage through this process a little more effectively than some of the hyper-growth firms that are leveraging the credit market more so that the company with a ton of free cash flow and a really strong balance sheets. And that's why I think can be some value in recessions, which is to be a stock picker. It's very easy to buy stocks in the bull market, but very often recessions in the bear market, it causes a fear among the investors before picking new stocks. However, it creates brief opportunities to really reload your portfolio to buy the stock that you have wanted to own, especially at the sale prices. But whether recessions are actually good for the economy remains widely debated. And I'll welcome your comments. What you feel about recession? Is it really good for the economy, or is it really bad for the economy? Recessions are very healthy in a way that the economy flushes out all the excess. So you think it might be really good to have that, saying everyone should have a heart attack once in a while because it will take them eat better and exercise more. It's just not true. Recessions causes job loss, and every job loss is enormous unfortunate. Becoming unemployment has enormously disrupted people's lives. It causes enormous pain for the families, for the communities. It's terrible. I'll finish it here. I hope you liked the video, and if you want me to keep making content like this, please hit the like button and subscribe and hit the bell icon so you don't miss any of my videos. This video helped you in understanding a little bit about recession. Don't forget to share the video and spread the love. It's me, Manny, signing off.